TheoTrade. This is Don Kaufman. It's March 15th, 2023. We're just seconds after the bell here on this Wednesday afternoon. S&Ps, they're effectively closing at the gravity point here, 39.31, which has been just a critical level that if you've tuned into any of the recent videos we've just talked about pretty much ad nauseum. Nevertheless, let's get right down to business here on this evening's video. Look, the fear trade, it's now returned to the financials, but there's a lot more going on than just big, bad, scary banks. Yeah, we can take a look at Credit Suisse, we can look at Deutsche Bank, but before I get to any of that, let me give you one other area, okay, that I'm rather concerned in, and that would be none other than the energy sector. All right, this one kind of not on a lot of people's radar screens today. It should be. It's down over 5%. If you look at this in terms of auto expected moves, we are way outside, like a 2 sigma move in terms of the energy sector, the XLE. How do we interpret this? You look at it and you're like, well, okay, so the energy sector is taking a little bit of a hit. Taking a look at oil, which has now dropped to $68 a barrel in the near-term contract over here, off the lows of 65. The only way that I can look at the energy trade right now is, this is pricing in a significant probability of recession right here, right now. And that's basically my take on it is, hey, look, when you're seeing energy get absolutely crushed, you're starting to see layoffs. Obviously, there's discussion, of course, about Meta, which is just broke to new recent highs over here. It's laying off another 10,000 people. It's on top of the 11,000 people that laid off in November. Stock, of course, rallies on that one, but no, it's the energy sector that you really need to pay attention to because right now it's pricing in a deep and cutting recession. Obviously, rates are still going to be going higher in the very near term. We're going to hear from the likes of the ECB, that's the European Central Bank. Let's be very clear about that. European Central Bank, that's coming out tomorrow morning, expected to raise a full 0.5 point. So again, considerable moves over here. Meanwhile, we're still not out of the woods in terms of the financials. Let's actually cruise over to the XLF to actually begin our discussion here about, as I said, like that fear trade really has returned to the financials. The XLF, which is representative of some of the bigger banks, the big boys in banking over here. It also, of course, has Berkshire Hathaway in it, but nevertheless, you start to look the likes of like Goldman Sachs down 3%, JP Morgan taking a big hit, almost 5%, Bank of America almost unscathed today. Nevertheless, that XLF, now down about 2.6% today. But you want to look at it, again, from my perspective, I like to look at everything much more quantitatively, like sitting here and talking about it's down, it's got a back to you, Fibonacci. Look, how far down is it? All right. So last week's move was just decimation in terms of the financials. The slip early in the week, and obviously you're looking at almost a 5 sigma move. This week, take a look where we are. We're actually right on the lower edge of its expected move. And again, I want to quantify that for a second because don't freak out about this, but we're just on that lower edge of expected move, meaning that the financials in today's trade, they haven't done anything outlandish per se. Lower edge of the expected move. And I'm going to show you a wild kind of bifurcation. While the financials are on the lower edge of their expected move, go take a look at the QQQ. You realize the Nasdaq is actually outside the upper edge of its expected move. What a difference a couple of trading sessions makes where we look at the marketplace a few days ago and we're like, oh, this just looks horrendous. We're possibly going into some type of like financial crisis. Then you realize like the Nasdaq, it's got a little bit of a bid under it. The coming days are going to be critical. And I'm going to tell you exactly why they're going to be so critical. The coming days, the ECB and so forth, be critical because even though the S&P is finished lower today, the advanced decline line in the S&P 100, for the most part, it's about a 50-50 in here. What will be critical is if we see continuation of any sell-side activity to the broader marketplace, my expectations are, well, eventually it's going to cave in the entire market. And that's where you're going to see a precipitous drop in and around 3,800 and below. So right now, we're hanging in there tough. And again, we're right back to a gravity point, which if you asked me this earlier in today's trading session, I would have said, no way. Like, I mean, it looked ugly. I mean, ugly this morning when markets, well, even before the open here, trading 38.65. I thought for sure, we'd be trading low 3800s today. To see markets close only down 27 handles, frankly, that is the absolute best outcome that you could have seen out of today's trading session, that we actually reached back for a specific level. In the midst of volatility, you don't have anything to go on, you go with levels. And here we are once again at the 39.31, or just shy of it, but we're basically trapped on that particular gravity point. With, again, ECB coming out tomorrow could really rock the markets once again. If we are to see more sell-side activity, what you want to look for in the selling is the bifurcation, okay, between ultimately financials and energy versus, for instance, big tech, for that actually to break down. When I say the bifurcation, again, big tech, what is it doing? Rallying. What do you got in financials and energy? They're getting clobbered. If we start seeing more sell-side activity, what I assume, again, will happen is that big tech's going to cave in, and we're going to go down. And obviously, S&P is down into the, as I said, low 3800s. In addition to that, I think it's well worth kind of mentioning here in the SPX. I'm actually going to do this a little earlier on than I normally do, kind of in an evening video, because I want to give you a quick feel that, everything that we've gone through in recent trading sessions, you do realize that the SPX is actually up very slightly on the week. The week started in and around, 38.60. Now, what's very critical from this point forward, and I always talk about this on a Wednesday night video, a lot of trade activity, huge amount of volume, big expiration this week, and our expected move is plus or minus $115 for the week. What have we done thus far? Nothing. I mean, come on, we're up like basically 30 points in the week. Look, you got a tag up here or down here. Like, I'm not going to be satisfied with this week until we do just that. Now, when I say you have to, we don't necessarily have to hit all the way to, 39.80 or, big controversial statement over here, the 37.45. You don't necessarily have to. But I am going to tell you what we are involved in this week. This is a big expiration. This is what they call the triple witching. So between now and, of course, Friday, again, SPX options are going to expire. There's an AM settlement on Friday morning and a PM settlement. There's going to be tremendous, open interest volume trading in here. Like, look at some of the size, And what I'm talking about here in the SPX is there are tens of thousands of contracts that are rather near money contracts that are going to shift around gamma. We are going to be Mr. Toad's wild ride on Thursday and Friday of this week. There's a tremendous amount, of options coming into the expiration cycle that either need to be rolled, or they're going OpEx. They're going to expire. That kind of risk ultimately being rolled and or taken off, or being allowed to get to maturity, it's going to whip gamma around. And I anticipate, again, a lot, of short-term, fast and furious moves, not unlike some of the trade activity we saw today. I mean, it was, again, for a day that, it kind of was range bound. It was definitely a funky day. Moves were fast, they were furious. And as I said, the best outcome we could have seen today basically played out. S&P's only being down 30. They could have easily been down 130 or 160 on a day like this. Again, especially where some of that financial fear has returned, as I was saying, right? Credit Suisse, it's the talk of the trading community, rallied back up a bit. So there's a degree of risk, and an element that's gone away. Deutsche Bank also coming off some of the lows of the session. Nevertheless, this is going to be a conversation piece, and a continual conversation piece for days to come, is not only what banks might be at risk, but any domino effect ultimately stemming from that. If something like Credit Suisse is to go down, the implications clearly to not only European contagion, but here in the US. I mean, again, we're not looking anymore at like a small regional bank. And now we're talking about debt in Deutsche Bank. We're talking about Credit Suisse. The possibility, of course, of acquisitions in here is real. That's got to be a live conversation at this point. But this is a gopher too big to swallow, basically, for most firms. Nevertheless, moving forward on here, there's also some very disconcerting news on the front of bonds and volatility. And this is really what I want to kind of wrap things up with over here is, when I'm talking about, the fear of trade and financial returns, and then all of a sudden we look at the financials and you're like, wait a second, the financials are not even that bad. Like the energy sector is getting clobbered way worse than the financials. I get it. But my concern at this point moving forward is, then why are trades being just dumped into the bond market? I mean, trade is rushing the bond market. Trade is rushing the notes. Okay. Are they using this as duck and cover right now? I believe so. I mean, why else do you turn around and buy bonds? It's, what are you expecting in here? Eventually, they're going to raise rates, and there's actually a incredible probability right now of rapidly cutting rates, even in the halfway mark of this year. Like in June, they're even pricing in like, instead of a rate hike, we're going to be looking at rate cuts. All right, you can argue that maybe that's why the bonds are reacting. I look at the bonds right now, okay, and say like, all right, well, they're rallying, which looks like a little bit of a duck and cover. That is, money's actually shifting into the bond market to reduce risk, okay, of what could be imminent sell side in the S&Ps. What on the screen, though, confirms that? Well, the energy sector getting hit hard looks like it's pricing in a recession. That doesn't necessarily confirm it, but it definitely, I guess brings to a boil the fears of a recession out there. It's the volatility. The volatility is also very, very disconcerting at this point. Even though the marketplace, out of the woods necessarily today, you realize the volatility futures contract closed at or near highs. And a lot of people look at VIX, and the VIX closed at or near recent highs. But the volatility contract, the cause for concern here is that our backwardation is live at this point, meaning that for those of you that do not speak volatility geek, the APE, which has 35 days, okay, versus the May, which has 63 days, April volatility futures are now well above the May volatility futures, which puts us into a backwardation, which basically screams risk now, risk imminent, not risk tomorrow, risk is here. The risk in the next 35 days is actually larger than the risk 63 days from now. You have to realize the implications of that. We're in such an extreme environment that we're saying the world has a better probability of blowing up in the next 35 days than it does in the next 63 days, which is even difficult to comprehend. That's exactly what the markets are telling us. That, okay, the fear inside of the bond trade. Obviously, you see the energy sector getting hit. Look, keep your hands and feet inside of the vehicle the next couple of days. Be very constrained, okay, wanting to sell premium. Let it come to you. And I'm serious about it. Let it come to you, right? You're going to go out and we're going to sell some premium, no question about it, but let's actually forge into some new territory. Let's get it below the 38.50 before we start to fire off some trades. If we rally, so be it. We've got positions on. And I like to reiterate stuff like that. When I say we've got positions on, look, I'm stacked out. I got a lot of positions on, a lot of premium selling going on. Nevertheless, okay, I'm going to be a little bit reserved in the days to come. I want to see some new lows. I want to see why the bonds are all of a sudden trading 132, why the volatility is actually inverted at this point. Okay, and until I see that, I'm going to be less anxious to route some new trades. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.